This will be the lesson on turtle soup intricacies and order pairing logic, lesson number 3, I think. And this will be maybe a shorter one because there is less to say and more to understand. But let's start with what is turtle soup. So turtle soup, and this is a trade, this is a trade I took. So turtle soup is a force breakdown, a force breakout in this case, above a node high to redistribute lower. So this is the only way, and you need to understand that, because once you truly understand what this means and what this allow you, why the fuck you want to trade everything else? I mean, this is the way, and it is easily predictable if you use the correct techniques, but this is the way the market moves. Every market, in every time frame, in every time, because before every single big move, there is either a turtle soup or an S&T, period. And the reason why is because this market are used by big player, and I'm not meaning hedge fund, pension fund, treasury fund, not those big players with big pockets, even though they are, but by the market owners, by the smart money, so-called, the ones that moves the market, the ones that have control, true control over them, and they want simply to make profits. It's reasonable, and big market moves are the Fed, the BCA, Central Bank of Europe, are the Central Bank of Singapore, Japan, and those are smart money. Those are the ones that make money for the states. The markets are a way to circulate money around the world, and to enter or to execute their orders, their position, they have too big of a capital to do that, and so they use, in the modern area, they use algorithms. Algorithms are the one that ICT spoke about, that the market is guided by algorithm, one algorithm, they say. Actually, there are more, and they operate on every single time frame, even though mainly on the high one, because the interest resides on those, but the logic is the same. Stop orders, not your stop on your small broker, I mean larger stop orders of institution, like hedge fund, like real firm, and those kind of places. They have large orders, large position, and those positions are triggered, are induced to be created, to be accumulated at a certain price levels. What levels? Levels of interest for smart money. Stop orders are aggressive orders, like market entry. So they will hit, in some way, they will hit smart money resting orders, and I mean limit. In this case, smart money will put all kind of limit order here. Limit, sell limit, sell limit, sell limit, and they are placed by algorithm. They are placed and removed to create artificially a drawn liquidity at a certain levels. And once price reach that levels, they are executed. Why? Because people, and with people I mean funds and also retail traders, even though we are very small in the marketplace, but people buy up there. People buy either because they are in drawdown and they want to exit, or because they want to ride the wave up, what they think it is a way up. So they buy, but those buy market orders, because stop order are aggressive market orders. If you want to study truly how the market works, how each order interacts with each other, go study them. I spent 4 months understanding this. But they will be hidden by sell limit of smart money, and they are placed not all at one time, but slowly and steady, one by one, until the markets tours, because there are not more buyers anymore. So the sell of smart money cause the markets to go down, and these sells are placed by algorithms. It is 100% controlled. Same when they want price to remain a consolidation, they algorithm sell, buy, and they keep price in a certain price level. And this is the order imperial logic. When you want to buy, you buy, sell stops. When you want to sell, you sell at buy stops. You want to do like smart money. And this is turtle soup. This is why it's my only way of entry, only favorite way of entry, and this is why I'm so precise. I learned by Romeo, and you know his precision. Then I wanted also to touch on, I wanted to say this. You know, I assume you know the type of market or footprint charts, all of this, like institutional trading, online it is publicized by that. They are great tools. You pay for them, obviously, but they are great tools. You can use it to see inside candles, inside charts. But think a bit, what you see? You see what is already happened, obviously. I mean, you can't see the future, so you can see that at certain levels, big money sold. If you go to a footprint chart, you see that in this candle, this week, big institutions sold. And once the market turns, you say, oh, this was a place where smart money sold. And what you do, you sell here, maybe here, in any retracement, because you know that that high is sponsored by smart money. And that's amazing. I don't use that software, those software, but I entered here. Why I'm telling you this? Because I'm teaching you how to think like smart money, not seeing what they do. And by the way, you can't see with the depot market, you can see forex market because it is a not centralized market. You need to use mainly only futures. So you are limited by doing this. I can trade every fucking thing because I know how they think. I know how to gauge, how to predict which, and obviously I'm wrong, but that doesn't happen often. I can assume which level they are interested in because they work on a time schedule. Time. Price levels, and time. That's the only thing I'm looking at, and ranges. So this is to say to you that you can do this thing, and the how to do it is really, really simple. You will understand it with the next lesson, and especially in lesson 6, the one on time. That lesson is and I have to record it, but it is the best one so far that I can do, because it will give you a system and a true understanding of the charts. But let's come back. Turtle soup intricacies. Every turtle soup will always happen above, if bearish, above the opening price of a candle, and every single very bullish turtle soup has always happened below the opening price of a candle. And that's empowering, because you know that you have to wait for power of 3. And you can say, okay, but let's just say this 50-minute charts, okay, this is a turtle soup, the first one I can see. This is a turtle soup, so hold high. Turtle soup. This happens below the opening price of the week, and okay. However, it happens above the opening price of what? 5 minutes. Just to see better. Opening price of what? The 5 AM candle. And this is food for thought. You know that you need to wait for power of 3, always. The algorithm function in this way. And so you trade this way. And you'll understand very, very, very deeply this time concept in lesson 6. It is just an hint I'm giving you, but every single turtle soup you can see as always the power of 3 behind it, and that's beautiful. Also, every single turtle soup has always happened at a higher time frame key level, no exception, none. The only one that happens not at an higher time frame key level, because higher time frame key level are inferior to time, at least to me, are the ones at all-time highs. And in fact, I can trade only based on time, without a higher time frame PDRAs. However, they give you roughly a depiction of the zone you are looking to buy or sell. So you need to use them as a confluence with time, but time comes first. Because higher time frame key level without time are useless. So every single soup happens at higher time frame key level. Every single soup happens above the opening price if bullish, if bearish, or below the opening price if bullish. And let me check my notes. There are 2 types of soup, and maybe 3. I tell you now. So there are continuation soup and reversal turtle soup, and those are relative to the time frames you are looking at. And this is mind-blowing, because continuation soup doesn't require higher time frame PDRA. So let's go to the daily. This is a trend on the S&P. This is the reversal turtle soup, right? Your market profile is bearish, you are breaking through lows, and this is the reversal turtle soup. From now on this time frame, on the daily chart, every single dip below a low has to be bought. So dip below a low, also FG, bullish turtle soup. Dip below a low, turtle soup, continuation turtle soup. Sorry. Dip below another low, continuation turtle soup, never close below twice. Same thing here, rejection block, buy, and so on, so forth, until we broke below the low that broke the high. From this point in time, we are bearish, until the reversal turtle soup. So, sorry, this low, reversal turtle soup, and we broke above the high that broke the low. Market profile is bullish. Every dip has to be bought. This has gone below, and so on. You understand? Remove everything, and so this is the logic. The continuation soup doesn't require a higher time frame key level. Reversal soup does. However, as I said, this is relative to the time frame you are looking at, because let's keep this in mind. This reversal turtle soup, how do you enter in that? You see me enter in reversal turtle soup all the time, actually. How do you enter in this? Zoom out? Monthly chart? What is this? It is just weekly, it was, no, monthly, sorry, monthly chart. It is a retracement, quarterly shift, inside this order block, and actually it was this one. I take, and I will explain this Y, wick to the body. This is the thick down close candle that stabbed into the low. Close above, not here, not here, not here, not here, here, close above, means higher prices, retracement into that. So it is simply, on a higher time frame, a retracement. On the lower time frame, it is a change in market profile. And I know this seems obvious, but it is so important to understand, because this is the way you trade. So I need to check something. This is the way you trade the higher time frame. This is a 3 months candle. So a quarter. This is a quarter candle. Look, open, fall slow, skip the first portion, turtle soup into the key level, pre-manipulation liquidity pool, and rally. Power of 3 of a 3 months candle. You never saw that, eh? It is applied to everything. And this is how you trade a candle. You always enter in reversal turtle soup, because they are simple continuation soup on higher time frame key level. Same thing I did right here. And go back that and go reverse engineer this trade on ES. It was a hyper reversal turtle soup. Everyone was bullish up there. Everyone was targeting those relative equal highs. They were more prominent on Nasdaq. See? Everyone was bullish. They want to buy the retracement. And I sold to them. However, this was a continuation soup on a higher time frame. Yeah, a retracement into an higher time frame key level, and go find the key level out. So this is the logic of turtle soup and how to frame it. The other type I was speaking about, and I called it a type because it isn't really a separate way, but it is only an intricacy of turtle soup. It is the range turtle soup. So here, for example, this is a range in BTC daily chart. This is a range low, range high, and this is a continuation soup. No, sorry, this is a reversal soup for this time frame, because we were trending, breaking highs and rejecting lows until we begin to range. We begin to stay within this range. We rejected this high, we rejected again, we broke below, and we formed a range. So this is a reversal turtle soup, because from range market profile we go to trend again, and this happened to be the same direction of the previous trend. Sometimes it can be a topping range. What happens because on this soup, this is simply a retracement into a higher time frame key level. No, it was on the weekly. See, it was simply a little consolidation above this weekly FVG, and it is what you call a retracement in a weekly trend, right? So it is the same way of seeing the turtle soup on like the previous one, but it is a way to keep in mind. And I will hint to this, I will elaborate better on lesson 6, but there are certain times for ranges and certain times for manipulation and certain times for expansion. So keep this in mind. So coming back to us, let me check again my notes. Now, I also wanted to speak about shallow versus deep turtle soup. Because I think in all this time you have wondered, but how deep a turtle soup can be. And there are truly two ways of determining the journey of a turtle soup of price below an order low or above an order high. The first way is to consider the range before the manipulation, if there is a range, and this isn't a holy grail. This is a way of confirmation, standard deviation. So the range before the manipulation. The second way, it is the higher time frame key level, and understanding the higher time frame key level, you can gauge how much deep a turtle soup can go. Actually, there is a third way also, that it is time. Once price reach a certain level in a certain time, you can not predict, but you can not force, but you can expect a reversal, because as I said, the market works on a time schedule, and if your ideas is correct, it should react to a certain times. So what I mean by range standard deviation, it is what you think. So on the daily, for example, let's keep this. I go to euro because I choose so. Let's keep let's take, sorry, this day in my and they were London from the high. Don't know. Let's take a random day, and let's see if I'm correct. So let's take this daily candle. Okay. So here there isn't. Okay. Here, let's take this an example. Asia, it was the range, the time range before the manipulation, and in this case it was 20. Asia is 20 to midnight. The range is, and you can extend obviously this until here, because you can see the price range is still the same. So the low of the range is taken out with the manipulation, and it didn't reach a standard deviation of the range. Why? Because let me, okay, because the higher time frame key level was there. So see, you were already inside the higher time frame key level, and price waited, let's make this a light blue, and price waited for the correct time to rally. Price was already inside in Asia, see? Was already inside the key level, but waited for the time. That's why time is more important than price. In this case, a classic standard deviation of the range, like 0.5, won't occur, and this is a case of a shallow turtle soup because price was already at the key level. I give you an example of this. Let's take some other days. Maybe this. So opening time and closing time, 15 minutes sharp. Okay. So in this case, the range, you need to consider time. So Asia, you know, is from 20 to midnight. The price range of Asia is here, and here the low, that it is the same before and after the manipulation. So you keep this range in mind, you project the standard deviation, and in this case, yeah, shallow, that was why, let's say, because the higher time frame key level was already there, and maybe also daily, no, for our FVG, you were already in the key level, again, you see, it's the same thing over and over again, you were already in the key level, but price waited for the correct time to rally. Correct time, why? Because this is the end of Tuesday candle, not the correct time. Asia, not the correct time. London, yeah, low of the day. I can search for another example. So 11, range, no, I want, okay. This is also a trade that I took, you remember, the time-based breaker? Yeah. So this was an example of a standard deviation where you can use standard deviation. 17, range, Asia, 20, midnight, this is the low, that it is the same to this, almost. So, pam, 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 and the standard deviation was 1.25, because it is 25, half, one full standard deviation, 25, half, one, and in this case, half of this, because the higher time frame key level was this hourly order block. So price needed to travel a bit more because the higher time frame was not reached, higher time frame key level. So you understand everything, and standard deviation on the weekly chart are used on Monday range if there is a Monday range. If Monday expand, you let it expand. And go try it for yourself. On the monthly candle, it is week 1, if week 1 is a range, and that's it. So you can use standard deviation, but the main thing is the higher time frame key level. That's your benchmark. Now, I wanted also to talk you about the rule of displacement, because as you know, if you see price that smack into your key level fast, you may be scared of it, but it is the best thing, because see, price travel faster, everyone is bullish in this case, and go down. This is, and yeah, that I already told you about this quote, but the real moves in price are the steady ones. There is a clear example here. The real moves in price are the steady ones. The steady one. The sharp move are the fake one. And when there is a sharp move at higher time frame key level, it is where a soup is cooked, turtle are cooked. See? Because sharp moves are artificially created. So the role of displacement, you want to see generally displacement into the old high or the old low through it, smacking into the key level, and a reaction, a stop. In that, you need to say that speed in price, that stop. It is like a stop. So speed and stop. Accumulation, okay, it's okay, it's okay. Price is waiting for the correct time to go down. Asia, stop, correct time, rally. okay? But you need to see that enticement, that quickness in price disappear once it reached your level. And it is the same every single time. Nasdaq, random soup. My soup on yes, okay? 1 hour. It's better seen on the 30-minute chart. You can see price was slowly and steady. It was calm and nice, and then fast move in London. A second fast move and stop. There, gyrates around a bit, and drop. So the quickness in the entry and the quickness in the exit after you witness a reaction are key. And the final confirmation is the broke through, in this case a huge gap. It is even better, broke through the low that broke the high. Because you need to probe, not forget the old teaching, the old lesson, because I'm building slowly your house brick by brick. And every information is important. And this is what I said is, I will expand to this in lesson 6 and finally in lesson 7, maybe 8, because lesson 7, the 7th chapter is really dense. But yeah, I'm always interested in the range at the top of a candle, not video rays, not other shit, only in the range, in the top of a candle with my time frame key level. And in this case, as I told you, it is for you to find and for me to know. So write me in the chat, reverse engineer this trade and tell me not only what was the key level, but why I was sure that this was the eye of the candle. Final thing I want to say is the model 1 logic, because as you know, I hate pattern and I mean it, so I don't look at video rays, only on the higher time frames. On the lower time frames, I can't give a fuck actually of a breaker or an FEG. I'm truly doesn't interested in it, only in highs and lows and time on the lower time frames, so the time frames I'm trading. But logic of model 1 is key. Candle number 1 is the candle that is used to stab into an old eye, and in this case, let me check. Yeah, you need to go to the time frame where you can see a thick candle that stab into the old eye or low, obviously with the logic behind it. It is not a pattern, it's a logic. They use this candle, they inflate this candle with liquidity, with buying pressure, because smart money, yeah, algorithm buy for smart money, as I said. So this is used to dig into the old eye, and once it is broken out of, because candle arranges, when price broke out and closed below, this becomes a new level where smart money sell, or the algorithms sell for them, sell. They can't, and I told you why, they can't go over this candle again, because they will be in net drawdown, and because they control the market, why the fuck should they go in drawdown again? So once they do this, so they sell them again inside of this candle, because this is fair value to them, fair value. And yeah, I will, it is a range where you want to sell, and so if you use model 1 as your entry of choice, you need to put always your stop above, because I explained to you why above model 1 candle, always, 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 because it is a range where smart money sell. Sometimes they touch the rejection block too, but the logic is the same. You need to stick to your bias until it is invalidated. Same here. On the daily, same candle. You need to go to the time frame to see it, but candle that stab into the low used as support to buy again. See? And it is a trade on itself on the lower time frame. I assume that if I go to the lower time frames, there is a candle, see, candle stabbed into the low, close above this whole range is used as a zone to buy again. Same logic. You can't go to the 1 minute and expect that to hold. You need to witness on the candle that stabbed the low, because some people, let's say, yeah, it is not an order block. I mean, this is the low, let's say, and you go to the well, let's use, okay, well, any low truly. Okay, let's keep my trade as an example. So this high, the candle that actually stabbed into the high was the time frame where it shows was this hourly candle. You see, the first one, because obviously on the 4 hour there is one, okay, and it will work in the same manner. But the first time frame where you see a candle that from below the high to gone and close above to the high, or stabbed, the candle that actually stabbed the high, because you can say, okay, model 1, yeah, but never close below, so never close below this candle. It is the new candidate to be the model 1. Close below, okay, my model 1. What I wanted to say, if you go to the 5 minute and you search for the same thing, you can take this, okay, close below, no, work, stopped out. Okay, order block here above the eye, close below, stopped out. It is not an order block, it's a logic. The range they use to stop the low. On a higher time frame, I mean, you can't go to the 1 minute and assume, in this case, this hold. But why? Why? Because it stabbed into the eye of this candle. See? The eye of this candle. The candle, where it is? Okay. The candle that stabbed into this eye, once it is close below, it is used as model 1. And yeah, it is fractal, so you can use this as an entry to trade the weekly range. I didn't do that. I entered in the turtle soup itself, so right there, more or so, and this. But this is the logic of model 1. So never be afraid of miss a turtle soup, because if you miss the soup, you have the confirmation and you can use model 1. The reason I didn't use it I don't use it as an entry of choice is simply because not every single time it is retested. Sometimes price is in hurry, smart money are in hurry to make profits, and it is simply run away fast, like in the last example I took here, the last trade I took, this one. Model 1 wasn't, and by the way, my target, I wasn't stopped out because my target was this, and go understand why. The reason is, okay, I say to you why, but I low discount and premium, first key level in premium, and also paired with time of day 13. You will understand why, but this was a perfect exit. I exit right at this level, at 13. But in this trade I took, for example, model 1 wasn't tested, and so you have missed the trade. In this case I entered in the soup, and so it was a clean one, and this was based on time again. Every soup always happen below the price of a candle or above if bearish. Keep this in mind. And my confirmation was when you broke above the high that broke the low. Everything I'm saying is important. And next lesson will be on ranges. I touch on them a bit, but I will teach you advanced range theory, and also why CRT is important, and how truly to use it. So I see you in the next lesson.